introduction. So, hi everyone, I'm Immad Akhund, founder and CEO of Mercury. Welcome to our event today. We're going to focus on kind of AngelList, new rolling funds, and both Sahil and I have one, so we'll talk about that. Sahil Lavingia is the founder and CEO of Gumroad, a platform for creators to sell their work directly to their users. He was previously the second employee at Pinterest. More recently, he started his rolling fund. I believe he's got about 6 million per year committed to that now. He'll be investing 100 to 250K checks, and his limited partners include Tim Ferriss, Alan Hamilton, Naval Ravikant, and a few other great people. So we're going to talk about rolling funds kind of abstractly, and then specifically from like entrepreneurs' perspective and an LP's perspective and that kind of thing. So I guess firstly, let's dive into it. Like, what is a rolling fund, Sale?
A rolling fund is better than a traditional fund because you can talk about it publicly and you can raise money on an ongoing basis. So typically a traditional fund, you have to raise capital and then you're done, and then you deploy the capital, right? And then if you want to raise more money, effectively you start a new fund. And so you have like, traditional VC funds will have like fund one, fund two, et cetera, right? Different vintages, either per year or, per several years, et cetera. With a rolling fund, they're both happening at the same time. So you're raising money and you're deploying capital. You're raising money, you're deploying capital on a quarterly basis. So yeah, that's kind of there's a lot more cool kind of stuff that enables, I think, sort of second order, but sort of the simple version of it is you're taking a one-off event and you're turning it into kind of like a rolling subscription model, which has kind of a lot of knock-on effects.
Is this something completely new, or did this exist before kind of AngelList came along and did it?
It's pretty new. I mean, you mentioned evergreen funds when I was invisible. So it's been, there are elements to this, right? If you have a single evergreen LP, like some rich person who's just giving you capital as much as you want to deploy. But I think it's new. The legal framework has changed quite significantly in the last 5 to 10 years. So in 2013, there was the Jobs Act. So the sort of 506C designation that kind of caused a little bit of a stir in the VC Twitter kind of community like 3 or 4 weeks ago, because just a lot of VCs are kind of unfamiliar with it because it is new. Basically, as part of the Jobs Act, there's this new rule where you can generally solicit. So you can basically go on the internet and say, hey, I have a fund, I'm raising money for it, which you couldn't do before to kind of protect unsophisticated investors from getting scammed effectively. You still have to be accredited. There are these qualifications, but even before, you weren't able to tell anybody, legally at least, that you were raising a fund. And then specifically, I think on top of that, because the way AngelList is doing it, it's still so new that you kind of need kind of soft permission from the SEC. So last year, as recently as 2019, you can go Google SEC AngelList and find this stuff on the internet, which is what I did. Basically, the AngelList said, we're doing this. Is this cool? Does this count? Is this fine? And the SEC said, yeah. And so really, this was only sort of possible at scale very, very, very recently.
Yeah. I mean, another part of that AngelList likes saying, which is true, is that it's also enabled by software. So that it answers like a couple of questions that are being asked in the chat, which is that every quarter, from my understanding, every quarter is almost like a separate fund. So all the LPs that are committed in that quarter get access to the deals made in that quarter and any exits. So like if an LP is in quarter one, but not in quarter two, all the investments made in quarter one will accumulate. The exits from that will accumulate to the LP, but quarter two investments will not. So it's almost like a separate fund every quarter from like an LP's perspective.
Yeah, correct. I mean, if you think about it, like in 10 years ago, if you said, hey, we should do rolling funds, people would be like, the bottleneck is not this, because there's other things that are painful and expensive to do because there are all these humans. Every time you do a deal, this is pre-YC safes. Like the world was quite different, for early stage investing not very long ago. Doing a deal costs like 30 grand, raising a priced round of funding. And so if you said, hey, we're going to make it super easy for you to raise on an ongoing basis, people would be like, well, why? Right. So I think that's correct, that there is like software has made it so easy that I can do a deal literally in 2 minutes. There's a video of me on Twitter doing a deal in 2 minutes. The wiring part of the deal, obviously there's a little bit more there, but I think it's meaningful now because you can effectively do this at scale, right? By lowering the barrier to entry, and it's more interesting now than it would have been Yeah, very, very recently even.
So you said you weren't going to be a VC, but then I guess you're still not quite a VC, but you have you have a huge fund now. So like, what was your trying to transition and thought process?
Yeah, I mean, the reason I didn't want to be a VC is because when someone said VC, I had an image in my head, right, that included some of this stuff that we talked about, this kind of traditional fundraising process, and meeting all of these people that I didn't know. These sort of traditional LPs are typically like university endowments, family offices, pension funds, like these people that I would have to go network and meet, and it would be a deal, right? It would take me 6 months, 12 months, 18 months if I would even succeed to do that. And even if I just raised a small fund from the sort of people that I did end up raising from, it would have been that thing because of that idea that you raise money and then you deploy. You have to kind of pick a number, and then you have to kind of like go try to hit that number, and then you're done, and then you're deploying the capital. It just was so formal to me. It was a very binary thing. Are you a VC or are you not a VC? Right? Because you can't really do that. All of that stuff I described while you're running a company would be quite difficult. Whereas with rolling funds and with the 506c rules, I can massively scale that, where I can tweet about it. So much of my LP base, I just tweeted and they came to me, which, like try to do that with like it scales incredibly well. And so, yeah, it was really, I think it was a cognitive friction of like, oh, I can just start at like $100,000 a quarter, like do one deal a quarter. That's already going to let me invest in more than I would have been able to do personally. I could raise from like 10, 15 LPs. And that's how AngelList saw it initially. Like, I don't think they really saw it as, over time. But yeah, I think everyone kind of underestimated like the amount of appetite potentially for something like this, even just being able to talk about it publicly. And again, like I can still be a CEO. I can still run my company. I really don't feel like it's taking away anything from me running the company the way I am. And if anything, obviously I'm going to say this, but like, I feel like I'm actually a better CEO. Like often in the past sort of 9 years of running Gumroad, some of the worst periods of my time as CEO is when I was working all the time on Gumroad. Because basically like you do productive work and then you finish all the productive work and you still have all this time that you want to feel like you're contributing to Gumroad. And so you just pester people, you just annoy your team. And like, really it should be like, go away. Like, we're good. Like, come back tomorrow. You've worked enough. Like, please leave me alone. And so, yeah, I don't think these jobs are time sort of based jobs as much as they used to be maybe. So.
Yeah. There was a bit of, I don't know, controversy, but there's a bit of a Twitter argument about whether like CEOs should be doing like funds on the side or not. I feel like, we've already had like a pretty big movement of like scout funds and things like that. I feel like rolling funds, if anything, kind of formalized this kind of thing that was already happening.
Yeah, I think one of the unique things that I was able to do compared to maybe other CEOs, maybe even like yourself, is like I was able to test the waters, right? And like just go full on, say, look, I'm doing this. I'm running Gumroad as CEO. It's profitable. It's sort of the risk. It's been de-risked in a sense. Like my investors are they might not be pleased with the outcome exactly, but I was very upfront with what happened there. And a lot of them are LPs in this fund. Majority of them, I think, are. And so I was just able to just be like, look, like, this is what I'm doing. I don't have to pretend that I have this fund. Like, like CEOs have been doing this for a long time, as you mentioned, scout funds or these evergreen LPs or what have you, or, with the new Spearhead program that AngelList did. And so it's just like, this is what it is. Like, this is the world now. And truthfully, I think people want it. I think people appreciate the fact that these founders, like the truth is, founders typically will want founders on their cap table. And, founders want to be founders. So if you want both, you need something like this to kind of bridge those, bridge the gap.
And why, like from your experience, why do founders want founders on their cap table? Like, what's the benefit?
Yeah, ultimately the number one benefit is that you have more empathy than anybody else would, right? Because ultimately, like what I like to tell founders is like, I have 9 years, I have way more than 10,000 hours of being a founder. And it's like anything. It's not like being a founder is necessarily like unique in this way. Any job is like this. Like I could read 1,000 books about being a nurse or being a chef, and I would really never be able to really understand what it meant like, but if I could talk to a founder And it doesn't matter how successful or whatever if they did it for a bunch of time, if they've, if they raised money, if they've hired a bunch of people, if they've done layoffs, if they had to fire people, like you just learn so much from that. And so I always just tell founders, like, I'm not saying that non-founders are bad. I'm not saying founders are better than anybody else, but in terms of, if you want someone who's going to understand what you're going through, someone who's actually gone through it, is just going to be able to do that better, than anybody else. And yeah, there's so many things, honestly. I see it all the time where I can tell a founder, I'm like, as an investor, this is what I'm going to tell you. As a founder, this is what I'm going to tell you. And there's certain things that I know I would not have been able to understand if I had not started a company. Because some things just don't make sense. Like, for example, hiring being so difficult. Every single founder, I feel like, is like, we're going to start hiring. It's going to be difficult, but we'll get through it. And then you start it and you're like, holy crap, this is so hard. Like, I don't understand why no one wants to work for me. And you learn over time that hiring is just like one of maybe the hardest thing about building a company. But it's just one of those things that I really think, if when I was an early employee at Pinterest or whatever else, I was like, why aren't we growing? Like, Pinterest was doing this as a product, but we were hiring really slowly. It was really hard. We were getting all these no's from engineers. And I didn't get it as an early employee. Like, why is it so hard to hire people? I clearly joined this company, So being a founder really does give you, I think, empathy for that role in a way that nothing else really can.
Yeah, that makes sense. Do you think raising money as an entrepreneur, raising money from a rolling fund lead is different from raising money from like a normal angel investor or normal seed VC?
I mean, ultimately, probably not. Like, I think founders care about who they're going to be spending time with, and who's on their cap table and who's going to be helping them. But ultimately, I don't think it matters too much what the kind of like the legal structure of the deal is. I would say in one way that I do think it matters is I can tell a founder, this is my exposure to the deal. If I write $100,000 check from my fund, I have roughly this percentage carry, blended with the management fee redeployed and everything like that. It ends up being something like 35% or so. And so that's the equivalent of me personally having invested roughly $35,000, which, by the way, as personally, I would not be able to do. I don't have that much capital. The largest check I ever wrote was $10,000. So I'm already in 3.5x what I would have been able to be in for. Obviously not the same, because there's deal by deal, fund by fund economics are a little bit different. And guess what? Like, I raise money from funds, right? For Gumroad. I could not tell you to this day, like, what the exposure, if Gumroad sold for $1 billion, like what the person on the board, what, some of these GPs at these funds who are sort of like helping me out and did the deal, I don't know what they would have made. And that's useful. Like, guess what? Like, my employees are motivated by this sort of stuff. I'm motivated by this kind of stuff. So, like, not knowing that, I do think is a little bit weird, honestly. And I suspect that over time, like, transparency in the sort of the venture world will increase. However, that has nothing necessarily to do with rolling funds. That can be done for traditional funds as well.
So lots of people asking this, like, I guess, it's probably too deep to go into too deep, but like, what's the maths difference between a normal VC fund and a rolling fund, I guess, from an LP perspective initially?
I mean, yeah. What's the biggest difference? I mean, the biggest difference is you can sort of like temper your deployment, right? So, instead of saying, hey, I have a fund, Sahil has a fund, he's starting a fund, it's going to be, let's say, a $10 million fund. And I want, I'm going to write $100,000 check. And then, maybe 2 years from now, 3 years from now, 4 years from now, I'm going to raise like a much larger fund. I might have higher minimum. Like, there are all these uncertainties, right? Whereas with this, I can just say, look, this is my fund for the rest of my life. I don't expect to ever raise another fund. So if you want access to my deal flow, or you feel like I'm going to be a good investor and you want sort of a part of that, you can commit, it can be $25,000 a year, $50,000 a year, $100,000 a year. And you should really think of it like, I think, an evergreen deployment. And that's, if you want to think about it like a traditional fund, you can also do that. You can do 100K spread over 8 quarters, like a traditional fund would typically be deployed, and then stop. And then there'll be somebody else there to take your place. But yeah, I think it's a conceptual change, I think, mostly, but I do think it was tricky in the beginning to explain to LPs, like, this is, you're used to this model, this is the new model. But for new people, they love it because they're like, yeah, this is how I deal with like my Vanguard ETFs. This is how I think about investing in stocks. This is how I think about my mortgage. It's all a rolling basis, right? Like it's very common when you have these big purchases that you spread it out over time. So I actually think it makes a ton of sense. And it will basically be the default going forward. Every new person getting started, I think will choose this way to do it. It just makes so much more sense, and fits so much with how the world works, in my view.
So I've definitely had a bunch of entrepreneurs kind of reach out to me and say, hey, how do I start a rolling fund? Like, what do I do? Do you think like there's like a base level qualification or something before you're like ready to start a rolling fund as a, as a either entrepreneur or some other kind of person in the ecosystem?
Yeah, I mean, I don't want to, gatekeep anyone from saying, oh, like you can't do it. Anyone that feels like they should go through the process. I think I would say I'm very grateful for the fact that even though I didn't do a ton of angel investments, I did a few starting in 2011, and that just gave me it gave me confidence, right? Otherwise, I would be freaking out. Like I'm writing $100,000 check, like I don't know enough. But looking back and being like, wow, I made that like 10K because it was a friend or whatever, and it turned out to be great or not great, and I have a little bit of context around that. That is super valuable. So even if you're not thinking about doing a rolling fund today, I would recommend everybody start thinking about, it can be tiny checks like $5,000, $10,000, even less than that. In people that you really believe in, just to start building that mental model. And getting some of that skin in the game to show investors that you can get into deals, that you know what you're talking about. And just like being a founder, like you'll learn more from investing by investing than basically anything else. And so that's what I would say is like, if you've made a few angel investments, you have some sort of track record, it doesn't need to be extensive. I mean, there are venture funds that are pretty big that literally, they don't do that well. They don't have, sometimes like people will dunk on me on Twitter and I'll go to like their portfolio and I'll be like, I don't know. But obviously it takes time. It takes time to build that kind of portfolio. Companies don't get built overnight. But yeah, definitely start angel investing as soon as you can, and start, like one of the nice things about me, I think in terms of how LPs look at me is they know what they're getting, right? Like they can go on Twitter, they can, I have like a carbon footprint on the internet, right? There's tons of stuff about me. You can go listen to a podcast when I was 18, like whatever. And so I'm just the number one thing you want to look, I think LPs look out for, and same thing when investors invest in companies is like, is this person legit? Like, is this person a fraud? Is like, let's just get there first. Right. And so like, it's pretty clear for most people if they read my stuff that I'm like pretty legit. I'm probably going to be in this game until I die. And so that I think incentivizes people, because LPs, especially the traditional funds, as traditional ones, but also I want everyone to think about this like a really long-term thing. Like I want to do this investing thing. I don't know, full-time, part-time, whatever that might look like, but I want to do it for, 20, 30, 40 years. I really enjoy it so far. And so I want people to think about it like that. And I think making sure people understand that about yourself, and that you might have proof that those are your intentions, would definitely be helpful. And ultimately, I think it's also important to understand that like, while the openness stuff is really cool, ultimately like your early backers are typically going to be people who know you, right? And believe in you and have worked with you potentially before. That's always the case. I think if you do a Kickstarter campaign, you start a company, you're always kind of, going to your most devout sort of believers first before you kind of grow. And then you can take that proof and be like, hey, all these great people, invested in me, who are sophisticated, understand this stuff. Now you can go to like somebody else who doesn't and say, hey, look, doesn't, this person gets it and they're in, so yeah, that's kind of how I would think about it.
So to sum it up, like ideally have a track record of like investments, have a personal track record that's ideally public so people can see like this person is trustworthy and they do things, and ideally have some kind of initial backers that are willing to like, say, yeah, I trust Sahil with like 100K to go invest, kind of thing.
Yeah.
You obviously have like a pretty big Twitter following. Do you think that's like a useful kind of leverage to have?
Yeah, I mean, I would say that dovetails nicely with the last point that I think is just like have something unique about you, right? Because ultimately, if you say, hey, I'm hardworking, I'm a founder, like there's a lot of those, right? There's also a lot of people with big Twitter audiences too. But yeah, I think having something that says, which is the answer that you should have for the founders that you want to work with, which is like, why me, right? Like, why do you want me on your cap table? Is the exact same thing you should be telling LPs, because that's why they're investing in you, is because they can believe that you're going to be able to get on cap tables that they wouldn't know about or be able to get onto personally. And so, yeah, having a really clear answer for that. I think in my case, I do think the Twitter audience does help. I can certainly, like, for example, rolling funds, I think has a lot more sort of notoriety today because I have a large Twitter audience than if I had a smaller one. But certainly, like, they would have, been able to do that. Naval obviously has like a much larger Twitter audience than I do. But it does help. But I also, like, I always tell LPs, like, look, that's cool and sexy, but like ultimately, like, the stuff that I really think I can add value-wise to the founders is the stuff I would have been able to do without a Twitter account. It's like my experience working with Gumroad and all of these other things that, like, I can tweet these pithy statements that go viral, but like that's not that beneficial to the founders. What is beneficial is I might get deal flow. I might get founders coming to me first because I'm top of mind, because they see my tweets. People talk about how VC is kind of like a commodity and it has become a content marketing game. And if that's true, I don't know if that's true or not. I can certainly play that game and do quite well.
Someone's asking, you can ask people on Twitter to invest in a rolling fund. I think we talked about 503c, but so the idea there, Lisa, is that you can just post on Twitter and say, I have a rolling fund, click this link to like put money into it. The person that puts the money into it, the LP, has to be an accredited investor in the US. Do they have to be accredited if they're foreign? I actually don't know that.
Yeah, so the way it works, talk to a lawyer, but yeah, effectively what I think you could, as long as you fit the US qualifications for being an accredited investor, which is, $1 million in net worth or $200K a year for 2 years straight, including potentially this year, being on track for this year, you can be anywhere. So I have LPs scattered throughout the world, India and the UK, some folks in like Thailand, Singapore, et cetera. And yeah, so you do have to be accredited ultimately, and AngelList will sort of vet that. That's sort of part of the reason that they're able to do this is they'll go through the work of making sure everyone is accredited to a standard that the SEC has sort of said is okay, and have really operationalized that.
And then what parts of this does AngelList take care of versus like things that you have to do yourself?
I mean, really, they take care of almost everything. They have that page that, people can go sign up directly on if they want to become an LP in the fund. They can, have some information about, the fund and the terms and all of that, kind of the fine print. They take care of doing all of the wiring and all of the signing and everything like that. In terms of what I have to do, some basic tax stuff, for the fund. So I have to get I'll have to get a lawyer on retainer eventually to sort of like help me think through stuff over time. If I want to throw events, like I'll have to do that myself. If I want to, any sort of like financial related stuff, I will have to do myself. But yeah, besides that, all the back office stuff, they kind of handle the vast majority of it.
Yeah. A couple of people asked this question. What happens if, you have whatever, 500,000 to invest this quarter and you don't deploy 100,000? Is there pressure to deploy it before the quarter is finished, or is there flexibility?
There's flexibility. So basically, if you, let's say you've spent half the capital, you basically just get to roll over into the next quarter. And so, again, like, because AngelList, this is a great reason of the software component, like trying to deal with that with human beings and would not be fun, and it would be dangerous, right? Because that's some complicated auditing stuff that the paper trail would get kind of complex. So one great thing about AngelList is they'll deal with all of that for you, and figure out all the distributions correctly. So yeah, that just gets rolled over as if you had just deployed it in the next quarter, and LPs in that last quarter will just get a little bit of exposure into the next quarter.
I had someone complaining about this before. I don't know if you have an answer for this. If someone does invest for like 3 years, do they have to deal with 12 K1s? This K1 is like the tax document that you get as an LP. Do they have to deal with like tons of those?
Yeah, basically, because as you mentioned, right, like there's effectively a new fund every quarter. They will get 12 K1s. It'll all be in one packet, one PDF. But yeah, technically, yeah, they will get 12 different K1s. But you know, I filed taxes. I'm an LP in three funds, a tiny LP in 3 funds, I think. And I don't know, it was just as much, you know, I just uploaded the PDF to TurboTax or whatever I used, and it just, you know, filled it in, and I hit okay, and it was fine. So I don't know. I think people have that concern, but I'm not sure why.
Yeah, I don't think it's too bad either. Do we as leads have full discretion, or does AngelList have to approve all the deals?
So technically AngelList has to approve all the deals. So when you do an investment, you know, you fill out a little form, and it says, you know, what's the company, what are the terms roughly, and then, you know, do you have a relationship with this? Have you, you know, received a financial gift, et cetera? Some of these kind of questions. So far, everything that I've asked for to invest in, they've said yes. And my guess is that is sort of like, yeah, you know, to prevent fraud on the GP's part. But I assume for a long time, this is not going to be a self-serve product. This is going to be a sort of, you know, a curated group of people that they want to make sure are legit. And so I think it's mostly just there to make sure that you're not doing anything super drank. But like, first, you know, in terms of like, are they going to say, hey, don't do this deal because we think the market doesn't, you know, like I don't think they think about it strategically. It's mostly just a legal thing.
Is there a limit on 99 LPs? Is that right? I think it's something
So
like that.
yeah, so it's a little complicated. So there's it gets a little in the weeds, but effectively the way AngelList has set it up is you're allowed 99 non-QP LPs, and you're allowed effectively unlimited QPs. So the difference between a normal LP and a QP is, so there's this accredited investor term, which is sort of like the term everyone knows, right? Which is what we talked about already. And then there's a higher designation, which I just learned about through this process, which is if you have, I believe, $5 million in investments. That can include startup equity as long as it's vested, exercised, but effectively, quote unquote, liquid investments, which, you know, that's a much higher bar, 5 versus 1. And so you're allowed 249, I believe, or 250 of those. I know you're allowed unlimited because I think legally you're allowed that number, but you can have many funds in parallel. So AngelList would just spin up more funds. Okay. But yeah, non-QPs, you're allowed 99, including the GP if you are one of those. So yeah.
I see you've gone deep on all these questions.
I had to. I hit the limit and I was like, oh crap. Okay.
That makes sense. Let's see. So a few people asking about, like, I guess what is a syndicate, or SPV is something else to call them, and like, are they now dead, or do syndicates still go alongside rolling funds?
Yeah, I mean, this is a good question. Effectively, you know, I think syndicates needed to be there to get to rolling funds, right? Because rolling funds are effectively syndicates on a quarterly basis. They're SPVs every quarter. The truth is, like, if I want to just be super frank, like, I don't think in this new world, syndicates make a lot of sense going forward. I saw some of the sort of Twitter conversation, but as a founder, you know, syndicates are sometimes annoying, right? Because you don't know exactly how much money you're going to get from the syndicate, because they have to go, you know, kind of do a poll and kind of collect that. And then also you don't have the timing as you know, it's not like, hey, you can get back in 24 hours, which is not that different if you're meeting with a, you know, partnership and they need to sort of, you know, collude and come to a consensus decision. But I do think ultimately, as a founder, I don't like working with syndicates. I personally have never had raised money from a syndicate, and I would probably never do it because again, like going back to what we were talking about before, I want people with skin in the game, with sort of direct exposure, who've invested in the company directly or have exposure otherwise. Whereas syndicates often, they're doing syndicates because they don't have any personal money to invest, so they're able to kind of like utilize their network. But truthfully, like rolling funds are basically like an opaque, like a blind pool syndicate, right? Where you just like give someone money that you trust and they're able to do it. And frankly, I just think it's better. It's better for the GP. You can move faster. It's better for the founders. And frankly, I think it's better for the LPs, because they're going to get, you know, LPs are going to say no to good deals. And they're going to say yes to bad deals, right? Like the truth is, you want to back people that you believe in, and that, like, inherently you're looking for outsized returns. They're going to look weird and different. And like, I'm sure if I did a syndicate, like I guarantee you, like a good chunk of the investments I really wanted to do or want to do would get, would not do as well.
Yeah. I do think they have, like, I guess, two places in the world. Like, number one, SPVs require, like, or syndicates require like a lot less trust in the lead, which kind of speaks to this other point. But from an LP perspective, you're like, oh, I'm making the choice, and people still like being pickers. But either way, it's like you can have a lead who's maybe not got as much of a track record, but they bring a good deal that then they get backing for. So it can be a way to like step up a track record. Like I did a bunch of these in 2016 when I first started investing, and it was, back then no one was going to trust me with like, here's some money, go invest it.
It's also about liquidity, right? Back in the day, there weren't as many of these options if you wanted to raise from founders and stuff. So if you really wanted someone, obviously they still have exposure through the carry that they might have. So like the only way to get them may have been through a syndicate or, things like that. Whereas now if you have rolling funds and they're able to have these, then I suspect that syndicates will play less of a role in the traditional kind of Silicon Valley kind of fundraising stuff. For things like alumni networks and things like that, I think syndicates will probably still play a role. But yeah,
I think the other place they kind of play a role still is when you want to do pro rata or like invest at a stage where your normal fund does not operate.
So I've thought about this, right? So like, yeah, if there's a Series B for a fund for a company that I invested in, and like the pro rata, if I wanted it, would be the equivalent of like half, like potentially a full year's worth, right? If it's a big like $30 million sort of Series A, Series B or something like that. Then what I would likely do is just raise an SPV, a syndicate for it, and just go to my LPs and be like, hey, I did like up to, the 1x, and like the rest I'm going to do through this SPV. If anyone's interested, let me know. And so, but they'll become sort of what they SPVs specifically versus like these broad rolling syndicates, I think.
Yeah, that's true. What's the process like for setting up a rolling fund? How long did it take? What was the setup process?
Yeah, so the way I did it, I had the call with Naval like mid-June, and he was like, you basically you like, put together a memo, send it to a bunch of people, see how much interest you get, and then I had a call with AngelList. They started setting that up. It took like 2 to 3 weeks. My guess is it's probably faster now. I've heard it can be much faster. Avlok on record has said 48 hours, which is incredible to me. But yeah, that sounds great. And then I just basically like, tweeted about it a few times, did a webinar, and then, because I'm a very software driven person. So I like basically just have all these Notion docs. And so anytime someone hits me with something, I just say, go read this Notion doc. And then, if you want, here's a Calendly link if you want to, talk about it. But probably the majority of people like just, signed up directly. And then when AngelList finally had, so I started doing that before AngelList had the thing. So I was collecting things in Notion. And then when AngelList had the page, I just DM'd everybody or emailed everybody. And then when they had it, I just replaced like the bottom with the AngelList link so people could just self-serve it. Yeah.
And what is your investment philosophy? Like, what will you invest in? What will you not invest in? What do you look for?
Yeah, I mean, I really want to invest in like really high quality people, really high quality products. I think that's important in terms of building a really great scalable business. But also I just think it serves my personal interests the most. Like I want to back things that I feel proud about talking about. And like, for example, I really believe in rolling funds being a great product. So I can like go out and feel comfortable talking about it. I assume you're the same. I think Mercury would fit. I would love to invest in Mercury. But like in general, I think just like finding really like really hard problems that are solved really elegantly with like awesome software that like I'm excited about using, excited about telling other people about. I can go tweet about it to a bunch of people. Like that's the kind of stuff that I think is in my wheelhouse. Typically that means the founders are technical. It doesn't mean they need degrees. They don't have to go to Stanford or anything like that, but they need to be proficient at building stuff. So yeah, that's kind of the stuff. I don't care about sort of pre-revenue, post-revenue, stuff like that. If you have metrics, I'll want to see them, but like they're certainly not necessary. The one thing I do get a lot of is ideas. And I always struggle with ideas because for me, it's like, it's not that much work to go from an idea to a prototype. And so like, why? What's, so if you are sort of that early, it's always great to have an answer to like, why hasn't this already been built by you, not by somebody else or by somebody else, right? Like why now, why you are really important questions to have answers to.
Do you think that, previously everyone used to say like SB Angels is actually kind of relatively famous for saying that like they won't take any cold emails or cold connection. It has to be like a warm intro. I don't think you mentioned anything about warm intros in there. Is that something that you actively don't look at, or like you care about warm intros, but like you kind of do a bit of both?
Yeah, I mean, I do both. People will. I'm not going to say no warm intros, right? If people want to send me stuff, that's great, and I will look at those deals. But I don't think there's an inherent advantage to it. I really believe if anyone emailed me totally cold, I'm going to take it just as seriously, because that's my job as an investor, is to take those. I mean, to find those diamonds in the rough, right? To be the first check into some of these companies. That's, I think, where I'm going to build a reputation at least. Uh, and so, yeah, I think cold is super important. I'm actually building some software now so I can actually scale up my sort of cold pipeline, because I think that is going to be a sort of competitive advantage. I mean, YC is a great example of probably the most successful, or one of them. And the reason they're able to do that is because they find the people before they're able to get warm intros, right? And so I think if you're willing to do
How
the
many
work.
reach outs do you think you get per week from like?
Oh, well, right now it's hyperinflated because there's just so much buzz around rolling funds and like my fund launch and stuff, and YC demo day now. But yeah, probably I would say maybe 500 to 1,000
per week? Wow.
Yeah, but it's inflated. My hope my hope is that it gets down to maybe 100 or 200 a week.
You try to look at all 500 of them? Like you
I
try
look
to
at every single one. Yeah.
do you respond to all 500 of them?
No. Yeah. So there's yeah. So I look at every single one. I don't respond unless
What's your funnel from there? Let's just say 500 in. How many do you respond?
Yeah. So this is actually part of what I want to publish with the sort of transparency stuff. Once I have it all in data, it'll be on a website for everyone to see. But yeah, so let's say the rough math is for every 100 sort of cold emails or DMs I get, around probably 5 to 10 of those I'm going to want to talk to, like I'll schedule a Zoom meeting with. And for every sort of like 30 to 40 Zoom meetings, I'll invest in one, maybe two. So like it ends up being probably like, sort of a 500 or so per sort of cold per investment, which actually kind of the math kind of works, hopefully, because I can sort of do around 10 or so deals a quarter. And so, if that is sort of 200 emails a week, I can do it. I'll find one of those cold. And then obviously on top of that, there's all the warm stuff. The truth is, if you come in warm, it's not the fact that the warm is better than the cold, but typically the warm is just going to be like much more farther along, or they're going to, they just have, they're often raising around already. And I'm just like coming in near the end of it. They already have a lead. And so the conversion rate is just like far higher with warm. But my goal is that I would love to have like both of those in my portfolio. I would love to have people that were cold, that I invested in that did super well, not just like warm. And I don't think obviously there's like all this talk around diversity and tech and things like that, and I'm not going to say like any approach is right or wrong. So people have very critical stances, but ultimately like a venture investor should decide what their strategy should be, and stick to it and feel good about it. And I would just not feel good about saying I'm only doing the warm. I really do think, and obviously I think it's going to be better for the returns as well.
Do you worry a little bit, and I guess this is more for you personally, like if you're doing 10 investments every quarter, that's 40 investments every year, right? And 80 every 2 years. Do you worry a little bit that like, I think the way rolling funds work is like as a lead, you have to like clear all 2 years, you have to clear all the money before you get any carry. To do that, you basically have to, like, a company would have to be 80x your initial investment for it to like clear the, pay back the fund or something like that, which is like often how investors think about it. Do you think that's like too diversified, that like you're going to have to end up having like multiple unicorns every year to get there?
I mean, ultimately the most important thing, like people have all these opinions on fund construction, and I really think it's as simple as like just pick a check size and stick to it roughly, because the truth is like, if you write only 100K checks or you write 500K checks, as long as you have enough of a sample size, like I think that's the hardest part is once you pick the number, just stick to that number. Because you don't want like your big winner to be a tenth of your average check size, right? Which is often what happens. It's more likely than not, but given the power law returns, you're going to have much more bets on the wrong side of the spectrum than the right side of the spectrum.
Yeah.
And so just, try to make your max investment size like the standard. That's kind of how I think about it. And then, but I totally expect to have multiple unicorns. Of the first 6 investments I did, one was HelloSign, one was Lambda School, which just raised a Series C, $74 million, and one was Movable Ink that just raised a $30 million Series C. And so obviously I don't know how to be able to sustain that track record. If I do, it would be phenomenal. But that's not 15x or more in 9 years or something, not including Lambda School. But yeah, I mean, ultimately I think I will be a great investor, and like a lot of this math doesn't matter like in terms of diversification too much. As long as I sort of stick to the fundamentals, which is to pick a check size. I only want to write 100K to 250K checks. I've already had people say, can you do 25K? And I'm just like, no, like it's just not going to return the fund unless it 360x's, at that point.
Yeah.
But yeah, I think, I will say like one of the reasons I did not do a lot of angel investing in the early days is because I didn't have that much capital, and people would say like 30, you need to do 30 before it makes sense. And I'm like, looking at my track record, no, the answer was 3 or 2 or even 1. Because they're doing like a spray and pray model, whereas like I'm really trying to do diligence. I'm investing in people I know. I'm a founder. I have a lot of this mental model of who makes a really good founder. I think that was bad advice, frankly. And I don't think it's 1 in 30. I don't think my goal is to do 40 investments in a year and have 1 fund returner. I don't think that, like, to me, that would be a failure in my mind. Like, I want my hit rate to be a lot higher than that. And I believe it will be. And I believe yours will be too, because we're not trying to be top quartile VCs. We have jobs. Like, I think we would only do this if we really had really high conviction. Maybe it sounds cocky to talk about, so we don't talk about it. But like, I think the goal is not to be a good fund, right? And I think it is a superpower to actually run a company alongside and understand the market to a degree in depth that most investors just don't and won't. I mean, I'm sure you've gone through this. I've met investors that like I've admired from afar, and I'll meet them in person, and like they just don't, they don't know the difference between GitHub and GitLab. Guess what? If you're starting a company, that's like a pretty important decision. If you're building a software company, and so just things like that I just think the bar is, or like the difference between Ruby, Python, and PHP. These are pretty fundamental sort of, signals in my mind that I use to make decisions that I know most investors don't or can't use.
Should LPs just stick with people like a minimum number of quarters to like get like a diversified portfolio of their companies?
Yeah, so this is a really interesting point, right? Like time diversification comes up a lot, right? Because if you only invested in like 1999 to 2000, like you might have lost all your money. So you don't want to do that. You do want to spread it out longer term, just like you don't want to. It's like timing the stock market, right? Like if you try timing the stock market this year, you probably did worse. More likely you did worse than not. So yeah, I think you do. I always tell my LPs, like, look, it's a 4-quarter minimum, so I want you in for at least a year. But you should think about it, longer than that. And I actually think the rolling fund will actually incentivize me to be better, because like I've, instead of doing like 30 deals at demo day, I have to kind of be like, I can only do a few because I have a certain amount of capital to deploy right now. And I actually think like, it's better to have that discipline around I can do X amount of deals. Versus I have this much money to spend over 3 years, and then like within 18 months you deploy it all. This happens very frequently with new investors because you get so excited about all these deals, and then you're out of capital, and you weren't as diversified as you might have wanted to be.
I guess like a few kind of specific questions. Does a rolling fund lead have to be an accredited investor?
So I believe the answer is no. You actually, it's kind of weird. Yeah. But like technically, as long as you don't have a GP commit. So one of the reasons it's common, I think, thought of is because almost all LPs have a GP commit, right? A minimum that they're putting in sort of their own skin in the game. But technically you don't have to have a GP commit. That's just like sort of industry practice. And so, yeah, technically if you're not a GP in your own fund, you don't have to be accredited. You can be an unaccredited investor. And actually, become accredited through that process.
What happens if you're rolling your management fees into the fund? Does that count as a GP commit that needs accreditation?
I think it would count. I'm not sure, but I think that would make it count.
AngelList is actually very open about answering those kind of nuanced questions. So, either me or Sahil can put you in touch if you're seriously considering being a lead. What are the fees? A few people asking about fees. Who's charging? What are all the?
Yeah. So AngelList just rolled this out today, but they made the fees way lower. So thanks, AngelList. Yeah, basically it's 1.5% for per quarter for forever. That's just sort of like one-off cost. So let's say I have $1 million. It's it's going to be, what is the math on that? $15,000. And there's a minimum of 20K except that's foregoed for the first 2 quarters while you're kind of getting spun up. So it's actually incredibly affordable. If you did the math on a traditional fund, like it's much more expensive. Sometimes it doesn't seem as much because it's like free, but then you realize like, well, you have all these admin costs that add up hourly over time. But yeah, it ends. So the way to think about it as an LP would be, if there's a management fee of 2% a year, you're now paying 2.15, right? Because it's 10 years that you don't have to, it's amortized. So yeah, so it's actually, to me, it's
and then there's also the standard kind of 2 on 20, right? Like 2% kind of management fee and 20% carry.
Exactly. Yeah. So there's the GP costs, and then which are traditionally 220, and then it's sort of 0.15 per year for 10 years per quarter.
Got it. So where do you think the future's going here? Like, you kind of talked about like any new person should probably do a rolling fund rather than any emerging manager. So does this just settle into like in the future rolling funds are everything? And I guess like a related question to that is, I like Naval and AngelList, but is this too much power in like one entity here to be like controlling the future of like investing?
Yeah, I mean, ultimately, my guess is that AngelList will have competition. They have a lead. They have a head start on this. That will probably be a couple years, a year or two, and they certainly have a branding head start. But AngelList has kind of had a lock on like early stage marketplace connecting LPs and syndicates and startups for a long time, 10 years or more. And it's just like it's kind of like if those people are good, then it's good. If they're not good, then it's not good. Obviously, like if AngelList tomorrow said our fees are now 30 times higher, I'd be screwed. I'd effectively have to. But again, like the beauty of this kind of thing is, as AngelList has said, is like, look, it's just a legal structure and some software, right? So you can always leave. You can always I can go work with an advisory firm. I can take the management company and I can go do that. And so I think ultimately there's a free market here, and so like AngelList is sort of like going to be constrained in that way. In terms of where the feature goes, I'm making a bet on AngelList. Like I'm making a bet that this is it's like when people compare like remote work to co-located work. I'm like, yeah, you can compare the two, but like remote work is like months old in the mainstream, and co-located work is at least decades old, right? And so, give it some time and we'll build tooling and we'll figure some stuff out. But my guess is that rolling funds will enable all sorts of interesting, cool new stuff like this stuff that I'm going to build around the cold pipeline stuff. I'll open source all of that. I think you'll have much more liquidity. And when you have liquidity, you have opportunities to build more software for that group of people. So I think it's going to be interesting. I mean, even just stuff like the 99 LP limit, like what if that goes away? I mean, if I went on Twitter without a 99 LP limit, I would literally have launched with like a $10-20 million a year fund, which like going from a cold start to having virtually one of the largest early stage funds on the planet, with an incredibly diversified LP base. So I would be accountable to no one in specific, would be game changing, frankly. Like it would be really crazy. And it might be a good thing that that's not allowed, right? There's a reason those rules are in place. Yeah. But my guess is just like the 506C is new because of the internet, like it's sort of like that sort of new use cases are going to enable the regulation to sort of support them. And that's going to enable more new use cases. And there'll be sort of this kind of like interlocking flywheel effect there.
All right, one last question that kind of feeds into the end anyways. If someone cold contacts you, what's like two or three things that if they say like really stand out to you as like, oh, I should really pay attention?
Yeah, I mean, I think it's the stuff that I'm surprised when people don't do it, and I should write like a post on how to do this. But it's just like, what is the problem? What is the solution? Why are you building this? What's the origin story here? Why now? Why hasn't this been built before? Why you specifically are going to solve this problem. What have you struggled with? Like, what have you learned through this process? Like, teach me. I like emails that teach me something. I'm almost always a yes on. The emails that are the worst are like, hey, I have a startup. We're raising money. Click here to see the deck. I'll still do that, but I'm like, you just wasted a great opportunity to teach me something. Tell me a story. And make me
Won't
feel
that
like
make
you're
it
mentoring
kind of a
me.
long email if they're like putting all of these things in there?
It might be, but I think that's fine. I definitely try to keep it short, but even just like one sentence, like I had this problem. I built this. This
Yeah.
is the name of the company. There's some people that are like emailing you about my company. Click here to see the deck. And I don't even know the name of the company. I don't know anything. I don't know where they're based. Like use the email as sort of, because I'm making a decision at that point. Sometimes, if there's a bunch of typos and like to whom it may concern, I get those emails sometimes. Like write it to me, please. Like
Yeah.
I'm one of 100
Yeah, the
investors.
worst one is when they write it to someone else. To
No,
Paul.
yeah, I guess hey Steve, and I'm like,
Disqualification.
yeah.
All right, Sal, this is great. Thanks for taking the time.
Thanks for having me.
How do people get in touch with you?
Yeah, the best way is to DM me on Twitter at SHL or email me sahil@hey.com if you're interested in being an LP. Or if you have any questions as a founder or an emerging fund manager, you can ping obviously Mod as well. But yeah, I'm happy to help as I can. Awesome. Thanks so much for having me.
Yeah, thanks for coming, Sal. Seeing you. Bye.